So it's interesting. If you look at what's happened over the course of the last 3.5 years, it's been a really interesting period. In February of 20, the pandemic began, but we didn't really expect lockdowns. In April of 20, everyone expected a global depression. We got a boom. Folks underestimated the risk of inflation. Consensus underestimated the risk of higher interest rates. Most recently, this last year, everyone expected a recession at the beginning of this year, and we've had actually a strong growth year. So I have two big takeaways from that. The first takeaway is, I think we have to be a bit more humble. I think there's something wrong with our pattern recognition software these days, and we got to recognize that our capacity to predict the future, always an iffy thing, but our capacity to predict the future today, relatively weak. The second implication, which I think in part comes from the first, is that we're in a period as investors where resilient strategies are particularly valuable. Where strategies that are going to produce good returns across a range of different scenarios, those are particularly valuable today because we don't know what we're going to get. Private credit firms are both beneficiaries of higher interest rates and are at some risk from higher interest rates. Let's talk about both. The predominant portion of our loan portfolio is floating rate. So we are receivers of higher floating rates. Hard for us to complain about SOFR, that's the replacement for LIBOR, SOFR going up because we're the recipients of that higher SOFR. But at the end of the day, we also have to make loans to borrowers who can pay us back. And if interest rates go up too much, it becomes challenging for a portion of the portfolio to avoid default. This year has been a very good year from a credit standpoint. Our portfolio has done a very good job of adapting to this higher interest rate environment, of growing despite challenges of an external sort, despite higher interest rates. I think that's one means of adaptation. It's focusing on companies that can do well through this period of higher rates. But I think it's going to, as it continues for a longer period of time, I think it's going to continue to pose some challenges for a tail of the bell curve of obligors out there in the world who are going to have more difficulty adjusting and who are growing less, and for whom this higher level of cash interest is going to mean a smaller and smaller margin for error. So private credit continues to take some market share from the broadly syndicated loan market. The history on this is interesting. It really started in earnest in 2019. Prior to 2019, if a private equity firm was looking for more than, say, about $500 million in financing, it went to the broadly syndicated market. There really wasn't a private credit option for that particular situation. All that's changed now. We not only see very frequent private credit solutions in the 500 million to $1 billion range, we've seen ones go up to 3, 4, 5 billion. I think we're going to continue to see private credit solutions offered to larger borrowers, but I don't think this means the death of the broadly syndicated market. I think there will be times when the broadly syndicated market is very healthy and competitive with the private credit market for these larger credits. And there'll be other times when the broadly syndicated market, say during periods when new BSL CLO formation is slow, when the BSL market is less competitive. I think it's going to become more of an episodic competition between the two markets. So deal activity started really declining in the spring of 2022. It was a direct consequence of rising interest rates and a perception that that would in turn lead to a slowing economy. We've seen this calendar year markedly lower M&A volumes than we saw in 2021. I think it's starting to get better. It's starting to get better in part because we're seeing less uncertainty. We're seeing more clarity about the future path of EBITDA, and because more time has gone by, and it's provided a period for some recalibration by both buyers and sellers who are getting more accustomed to today's multiples as opposed to the ones from, say, February of 2022. My expectation is if the economy stays strong, that 24 is going to see meaningful increases in M&A volumes from 2023. But apropos my comment earlier, I think we should be cautious here in making predictions. We haven't been very good at it in this post-COVID period. The largest driver of private credit has been the growth of the private equity ecosystem. When I started in the business of making investments in late 1980s, there were a dozen large private equity firms in the world. Today, there are thousands of middle market US private equity firms. And the private credit industry has drafted behind the growth of the private equity industry in providing solutions to the private equity industry. But that's only half the picture. That explains the development of the private credit industry. It doesn't explain the growth of Golub Capital and the success of Golub Capital. I think underlying our success has been a really deep belief in the power of long-term win-win partnerships. And we've been able to develop really strong relationships with private equity firms, with investors, with lenders that have borne dividends time after time in the form of repeat business.